Mr. Pankaj Murarka, the CIO at Renaissance Investment Managers, joining us on the show. Mr. Murarka, hi, and thanks so much for your time. First up, let's start by talking about your outlook for where the market is heading, 26,000, so at least looking optimistic for the Nifty right now. Your near to medium term outlook for the market, factoring in the global setup right now, given US equities are at all-time high. There is also some more certainty as we inch closer to a trade deal. So, and GST, of course, so lots of factors in our favor. Do you believe that it's all good days for the market going ahead?
I think, the bigger picture is that we've been in a period of earnings slowdown. If you see the last 6 quarters, we've seen a significant moderation in earnings growth. But I think the good thing is with the significant stimulus being injected by the government into the economy, we are witnessing early signs of revival of growth in the economy. And as a consequence, I think this starting third quarter, we will start seeing an earnings uptake. So on an aggregate basis, while FY26 might still report high single-digit earnings growth for the top 200 companies or the Nifty 200 companies, but I think we'll get closer to mid double-digit growth or about 13-14% earnings growth for the top 200 companies going into the next year, that is FY27. And in that context, I still think that index can comfortably do, mid-teens kind of returns over the next 1 year. So I think we are poised for a new all-time high, probably in the near future, as far as markets are concerned.
Fabulous. When you have a Vikas Khemani coming on a Monday and talking about Nifty hitting 29-30K, and the very next day you have Pankaj Murarka coming in and talking about record highs, 15% odd returns over the next 12 months. It's certainly heartening to see. Thank you, Pankaj, for coming in. And this is Harshya. Hi. Pankaj, talk to us about what will lead this rally. Private banks have largely stayed out of this rally, especially the larger ones. I know you're bullish on this, but you could well see 1 or 2 more rate cuts, which could delay margins going up. And that will be the crucial piece, right? Margins going up will likely drive earnings and therefore drive positivity in terms of returns. What is it that's keeping you positive with regard to some of the larger banks?
Well, Harsh, we continue to remain positive on the entire banking sector. I think we are already seeing early signs of revival in the credit cycle with uptick in credit growth. And I think we'll get back to, at the aggregate industry level, 12-13% kind of a credit growth into the next year. Obviously, larger private banks, one, their balance sheets are very clean. And secondly, given the kind of execution capabilities they have, I firmly believe that they will outgrow the industry, and valuations are very comforting for the sector as a whole. So clearly, obviously, banks remains one of the preferred, sector to be playing this upcycle in the markets over the medium term, over the next 2 to 3 years. And the very fact that if you see, we've had about something like to the order of about $10 billion infused, which is a strategic long-term capital that has come into India's financial sector in the last few months. We've across Yes Bank, the erstwhile Indiabulls Housing Finance, RBL Bank, and the last being the Federal Bank. So that clearly shows one, long-term capital coming to the sector, and the strong long-term growth potential that the sector offers for investors. And that, coupled with revival in growth, comforting valuations, and probably some more reforms from the government in the banking sector, albeit on the side of state-owned banks, will help the sector in totality. So I think, one, the sector should do well, though a significant part of our exposure remains to private sector banks. I think state-owned banks would do well if we have some reforms coming from the government. Apart from that, we've turned quite constructive on consumer as a sector for a while now. And I think the fact that we have such significant fiscal and monetary stimulus that's been infused into the economy during the course of this year, all put together, that amounts to about something like almost close to about 80 basis points of GDP. That's a very significant number, in terms of $30-odd billion of fiscal and monetary stimulus. And it will help revive demand in the economy over the next 3 to 4 quarters. The early signs are pretty constructive. So we like consumption as a sector as well, from a near-term to medium-term perspective.
Okay, so that's your take on some of the sectors you're liking. But on the flip side, Mr. Murarka, any sectors that you are not liking, you are underweight on right now? You've not been very constructive on insurance. What is your view over there?
The sector had headwinds for 2 or 3 years, but from here on, I think the sector should do a reasonably healthy growth because eventually insurance plays on the liability side of the consumer's balance sheet, and I think it's in India we have significant under-penetration of insurance. The sector had headwinds in terms of regulatory changes that happened in the last 2 years, but I think from here on the sector should do well.
Okay. Pankaj, on the consumption side of things, you said you've turned bullish. Talk to us about where is it that you're seeing value, because there are obviously pockets. For example, Bata came out with numbers, not the best set of numbers. Would you? So one has to be selective, right? So I'm trying to get a sense. What are you positive on, and what's the thesis at play there?
Yeah, sure. Harsh, my only submission is we should not look at this quarter's numbers as a reference point, because all of us know that the last quarter was impacted, one, because of almost 3 weeks of disruption in supply chain and demand because consumers holding back demand, and there was also an impact of a lot of companies having to absorb the GST impact on the inventory existing stock so as to give the benefit or pass on to the benefit to their distribution channels, where companies had to absorb that shock. So all of this did impact the last quarter numbers. I think probably even this quarter's numbers will have a slight bump up because of the rollover from the last quarter. But we have to look at business from beyond these 2 quarters. I think from a consumption standpoint, let me make this point. I think valuations in the sector are fair. They are not cheap. There's nothing that is cheap, I believe, in Indian equity markets, because I've been saying this. We are in the 6th year of a bull market, or 6th year of one of the most ferocious bull market in the second most expensive equity market in the world. US being the most expensive, we are the second most expensive equity market in the world. So in the 6th year of a ferocious bull market, you don't find value on the table in equity markets. All of those values have been extracted. What are you looking for? Companies which can deliver high growth or healthy growth and still be reasonably priced, and which is where I think consumers are, where we see a revival or growth upcycle coming back because of consumption picking up, and I think valuations are pretty much in line with long-term averages and are reasonably fair. So one could look to make reasonably healthy returns in consumption in sector. Talking about the pocket of the sector, we like both staples and discretionary, because we're coming out of a very sharp slowdown in consumption over the last 8 quarters. And during this slowdown, even the slowdown was so ferocious or so steep that even staples got impacted. Generally, in a consumption slowdown, staples is the last category to get impacted. The last consumption slowdown has been so severe that even staples got adversely impacted. And as a consequence, I believe there is a lot of pent-up demand that exists with consumers. And now with more money in their hands through income tax cuts and lower prices of goods and services through GST cuts, that will stimulate that demand and probably lower cost of acquiring those goods, because you can avail financing at a lower rate. With rate cuts coming from RBI, we have a triacor confluence of factors which really supports consumer demand. So I think we have all the factors in place, and which will stimulate demand from consumers across both staples and discretionary.
Murarka, let's talk about some emerging themes that are very hot in the market right now, if you could call it that. Digitization, AI, quick commerce. Your views on some of the companies that fall into the sector or the overall sector as well. Because on one hand, we're seeing a lot of AI revamp happening, but on the other side, you have competition amid internet stocks, quick commerce names. How are you playing this sector? Are you constructive on any of these themes?
We've been liking the whole digitization theme of the internet sector for a long time, and it's worked pretty well for us. I still believe it is one of the segments of the economy which will keep growing at 2x the nominal GDP growth, at least for the next 7 to 8 years, because we are still in very early stages of a life cycle of digital or internet penetration in India. It's just about 7-8 years that we've started seeing deepening of this penetration, and we still have a long way to go, probably a decade before we get to this sector gets to a maturity level, because the penetration levels still continues to be very low. Obviously, it's a sector where consolidation in businesses is happening very aggressively, because these companies, the way they've played this game of building businesses, they've completely inverted the whole model of creating businesses where they engage into very high level of competitiveness or hyper competitiveness at the early stage of their life cycle, even when they are small, and drive the industry towards a closed loop or a oligopolistic nature of the industry by the time, even when these businesses are very young in that sense, and which effectively what it does is, while these businesses are young and you achieve an oligopolistic industry structure, what it really does for these businesses it gives these businesses a very long growth curve, and more importantly, a very profitable growth curve on a sustained basis over a long period of time. But it's also an industry where winner takes it all. So because classically we've seen in digital businesses or new age businesses, the top 2 or 3 players tend to make 130 to 150% of the industry profits because everyone else keeps bleeding. So it's very important to make your stock selection right. But from a sector growth perspective, I think there's a very long tail of growth that lies ahead of us in this sector.
Pankaj, at this point, you've got an Eternal trading at maybe 3 lakh crore odd in terms of market cap, 20,000 crore in cash, 500 crore of profit. A lot of that contributed through other income of around 1,000 odd crore. At this point, would you find valuations reasonable, keeping in context the profit pool which is available to something like an Eternal? And Eternal is just an example, of course. I know you don't talk stocks, but Eternal is just an example. So given the profit pool that will emerge for some of the winners in this space, do you believe that valuation comfort available?
Let me reiterate, there is no value on table in Indian equity markets. So as long as you can buy growth businesses at reasonable price, you'll still be fine over a period of time. I still believe that, and I would advise investors, if you're looking at internet or digital businesses, don't look at valuation from a near-term lens. You'll have to zoom out and look at it slightly from medium-term, longer-term view. And the focus should be more on picking the winners or industry leaders or companies which will dominate the industry. As long as you get that right, and you have a reasonably long holding period, which is like, to my mind, anything which is 5 years and above, you'll still make very healthy returns in these businesses, because as I said, these businesses are still at very early stage of the evolution cycle, which effectively means that they have a very long growth curve ahead of them. And because these businesses have driven competition out by whatever hyper competitiveness at the early stage of the life cycle, they've created sort of a closed loop where the players who survive are profitable, and the profit pool for the sector will keep expanding. So these companies will have strong growth, but more importantly, very profitable, strong growth over the medium term to long term. So coming back to specific stock that you asked me, Eternal, let me make a broader comment on the whole food delivery or quick commerce space. I think the 2 or 3 players that survive in this industry will certainly make a lot of money over a medium term to long term, and it does make immense sense to be invested into companies within the sector or segment and just stay invested with them for the next 5 or 10 years. And you will be thanking yourself for having made a wise investment decision. So we continue to remain positive on all the companies within that segment or those sectors. And obviously we have investment within the sector.
Okay, wonderful. Great thesis. Okay, Pankaj, one more piece. You have defense, which is a theme which has come back into vogue. After a bit of a correction, we've seen a bounce back in some of these companies, and therefore valuations have seen a bit of re-rating as well. How do you view this one? Because it's been so volatile. If you were an investor, say in 2020, you've made 10, 11, 12x returns. What do you do then and what do you do now? If you want to make a fresh position, is this a good time to enter 15% growth kind of companies, large order books, great visibility, discounted for the next 3-4 years? How do you view it?
So as you rightly said, Harsh, once again, the low-hanging fruits or the significant excess returns have been taken out of the sector in the last 5 years, because the returns in the sector has been phenomenal in that sense. Having said that, with the new defense policy and the defense framework, India now has a new defense framework after our short fight that we've had, or a war we had with our neighbor. There's a shift in India's defense paradigm. And in context of that, the government of India has put a new defense policy in place, and that does provide, I must concede, a very long-term growth opportunity for defense companies in India. India is the third largest spender on defense globally, and India's defense expenditure are rising, where some of the other countries are trying to put a cap on their defense expenditure. And on top of that, even today as we speak, only 20% of our defense production is indigenized, which frankly means there is a very strong road to indigenization, which itself can drive growth for domestic companies. Valuations in the sector are very expensive. There are no defense companies which are available for less than 50 times multiples on the next 12 to 18 months earnings. So obviously the next 2 years of earnings or earnings growth is already priced into these companies. Investors investing into the sector has long-term visibility, but we'll have to look at returns beyond the next 2 years. But I still think that for investors having a 5 to 10 year time horizon, it still makes sense to have some exposure to the sector.
Okay, so that's your take coming in on the entire defense space. But Mr. Murarka, so glad to be chatting with you this morning. Thank you so much for your time, and thanks so much for joining us too.
Firstly, gentlemen, many congratulations. It's a proud made in India story. It's also a massive size that now you have grown to. So let me take out a minute or so to congratulate you and tell you that been standing on the sidelines and watching this story unfold has been a privilege.
Thank you, Harsh, and congratulations to you too.
2,000 stores plus. You have around 2,000 stores plus in India, 600 plus, 650 plus. When I add, then we arrive at the total store count of around 2,700 odd stores. How many of these are under the FOFO, which is franchisee owned, franchisee operated? The many are under the COCO model. And tell us how this has evolved, because now you're majorly focusing on COCO. What's led to that? A little bit on the business, therefore, on the distribution front.
Overall, I would say more than 80% of these are company-owned stores, both in India and international. And when we started the journey, initially, I think a lot of, we were largely a supply chain and an online company. And when we started the journey, we were learning retail. We had a lot of partners that had supported us. Over the years, we continue to work with many partners still. We have over 300 plus franchisee stores. But at the same time, I think the rate at which we wanted to expand and the innovation that we continuously want to do in the store, and the payback that we were able to achieve in the store, it was quite reasonable to open stores ourselves, and we were able to do a good job of continuous customer experience improvement by doing it ourselves. And when we went to international, I think the idea was that let's put our own skin in the game and understand that market. And of course, we did not want a franchisee to invest before we were sure of the market. But yeah, overall, I would say we now have, using technology, built systems that we can run these stores remotely with high amount of consistency that we can operate by ourselves.
Abhishek, hi. So it's coming to you. You've got nearly 1,000 crore in cash lying in your balance sheet at the end of June 2025. You are looking at another 2,200 crore being added to that, and you're profitable. So give us a sense, where does this money go? 3,500 odd crore rupees. How do you plan to utilize all of this, and how quickly?
Thank you, Harsh. Like you pointed out, the business is actually generating cash and is free cash flow positive. But at the same time, we are very early in the journey. So we will be investing in manufacturing. We will be investing in expanding our reach in all channels, building our brand, and also technology. So these are the 4 areas where a lot of our investments will be going into.
And can you give us a breakup of that?
Yeah. So out of the 2,150, there is for store capex and store payments. That is a majority of the payment, and then there is branding and technology, and then 35% is reserved for general corporate purposes and unidentified inorganic.
I think as a journey at Lenskart, I think we are still quite early in the journey. I know we are hitting the public markets, but nowhere this category right now is at a stage where one would assume that we have kind of arrived. I think it is quite early in the journey. Lenskart's market share in India is still 5 to 6%. The market is growing at 13% odd. The number of people needing glasses are growing, number of eye tests are growing. So it is quite early in that journey, considering, and that is why the investment we are raising in the IPO.
And Piyush, therefore, how should one look at Lenskart? Talk to us as you would talk to an investor. Now, this is fascinating because I now sit on the side of the sharks, right? So give us a sense. How should we look at Lenskart? Is it largely going to be focused on growth? Is it going to be more focused on profitable growth? How should one look at it?
See, firstly, growth is usually profitable if you are, at least in the long term, if you are creating value for the customer. And I think at Lenskart, we believe in the thought process of creating 10x value. We don't like incremental value. When it comes to Lenskart, we have been very particular that the product quality and the product price to the customer both come together, and that total customer experience package creates a 10x, a 10x value for the customer, not an incremental value. So I think our focus is going to continue to give surprising experience to the customer. From a shark perspective, if I was pitching this on Shark Tank, I would say, this would be an investment into a mission to give vision to 1 billion people. We have only served a few million people right now. We believe that we have the intent, the commitment, the talent and the culture, and investments in technology, which will continue to make to eradicate visual impairment like we did polio many years back. And so please be part of that journey in helping us make the world a better place.
And Harsh, if you think about the business, right, it is the unit economics, the payback periods that are basically the soul of the business. So in that sense, the growth and profitability for us is positively correlated, right? So it is not a either or question. They are positively correlated.
Right, and therefore, Abhishek, does profitability continue to pick up as revenue continues to scale higher and higher? And I'm not trying to allude to the fact that there has to be, I'm just saying that there has to be a positive correlation to it. Is that the way one looks at it?
Yes, I think you have factors like economies of scale, you have operating leverage, you get marketing efficiencies. So all of these are naturally accretive to the overall margin